Hey, Bulls and Bears, we are back. It is Friday, February 24th, 2023, back with another dose of economic reality. Let's get right into it. Some of the news that I'm reading today is surprising, and we'll talk about why it's surprising. But most of it's actually not so surprising. Let's go ahead and get right into it right now. As I am recording this, stocks are deep in the red. The Dow Jones down by 350 points. It's about 9 a.m. today on Friday. Things could change. We'll see what happens later in the day if they pump this back up here with maybe some money out of the Fed, some easy money, some liquidity. But stocks are sliding after the Fed's preferred inflation print comes in hot. Folks, we told you that inflation was not actually slowing down, that it was actually getting worse. And the markets shrugged it off. They shrugged it off. They shrugged it off. They ignored it. And now it looks to be that the markets are finally pricing in reality. So it's amazing to me that we have these traders out there with billions of dollars, investment firms, hedge funds, etc., and they weren't aware how dire the situation was with inflation. They're only now realizing it, and now they're deciding to sell off. U.S. stocks tumbled Friday as Fed's most closely watched inflation measure came in higher than expected, in another sign that price pressures had become sticky. That's the new term now, by the way. It's sticky, right? So first it was transitory, then it was peaking, then it was now it's sticky. So what's the new phrase they're going to be using? Maybe this time next year when inflation is still here and getting much worse. Also, be very cautious. Not only are stocks selling off because the people are realizing, investors are realizing inflation is here to stay, also companies are starting to cut dividends. Not all companies, but many big companies have cut or talking about cutting their dividends. And this is what they do when they want to raise cash. And it's going to be interesting to see which companies are going to do it. Also, I just read an article that the average 401k investor, retirement account 401k, the average investor lost 20% of their value last year. 20% of their value, folks. We told you this stock market had peaked in late 2021, early 2022. And I lost zero in my 401k because I'm in a money market and it doesn't give much of a return. It's about 1.7% right now, but that rate has been going up. And actually, I just saw a CD. I saw an advertisement earlier for a 11-month CD, close to 5%, if I remember correctly. And I just wanted to bring it up here to make sure I'm remembering correctly. Now offering 11-month 360 CD with a special rate of 5% that expires in March. Depends on if you want to keep your money tied up, but 5% is a good return compared to what we've been seeing over the last few years, that's for sure. Even with a 5% yield, you're still not keeping up with real inflation, which is running, even if you look at the official number, it's running above 6%. And we're still in a very, very unusual environment, not just that we're coming off interest rates that have been rock bottom for a decade plus. We still have the banks not really incentivized to encourage people, or not incentivizing people to put money into their institutions because they can still loan out money that they don't have right now. They don't have to have any money in reserves to be able to make loans. It's a zero reserve requirement. This has been going on now for over 2 years, close to 3 years now, since the health crisis rolled out in 2020. And that was supposed to be temporary to help the economy during that time of an emergency, but they kept it in place, and it's still in place as I'm recording this today, about 3 years now. Right? Just think if the banks had to have the money in deposits to cover all the loans that they gave out. What they would have to do then, they would really have to raise these rates that they're offering for people to put their money into the accounts to incentivize people to give them money. Right now, they don't really need to incentivize people because they can still make these loans without having the actual money, without having the deposits in their bank. Do you understand? So it's very unusual still what's happening right now with the zero reserve requirement. But even before that, it was still barely anything. It was slashed down from 10% to 5% over the years, to 1%, and then ultimately down to zero just a few years ago. So very strange, very unusual, and it's surprising they're even offering a 5% rate of return right now, or yield. And I'm sure if you look into it, it's probably a minimum of 10,000 or more. I'd have to look into it, but not something I'm really into is the CD right now because the rate of return is so low. And also because just I know what's happening behind the scenes at the banks. I know that they really don't need this money. So what's the catch? What's the scheme here? Is the question that I always ask. To me, it's amazing to think about what banks would have to offer if they actually had to have the money in the deposits that they loan out. So these companies, these banks that offer credit cards, 20% plus a lot of times, they would have to offer people 12, 15, maybe even 17, 18% return on their deposits if they actually had to have the money that they loaned out. So it's pretty interesting to think about. All right, but this is just one of the many flaws and downfalls of the fake fiat slash digital money system, where you don't actually have to have anything physical to back up the paper that's printed. Right, and that's why all these paper currency systems are only here for a short period of time. I mean, I say short period, but the average is about 50 years for fiat currencies, and we know the dollar came off of the gold standard in 1971. So we're already past the 50-year mark now, and it's no surprise that we're seeing what we're seeing. This to me looks like the end times for the U.S. dollar, not only as the reserve currency, but even as a currency at all, because I think we're to the point now where a whole new monetary system is going to have to be ushered in, because we're seeing such widespread global devastation financially. And I actually read that about half of the world right now is in poverty. And we take this for granted here in the U.S. that we have this reserve currency that will always have money thrown at us when times get hard. But see, the rest of the world doesn't have that option, and if they do try that, you see what's happened in some of these other countries that's just tried to print their way out of hard times, and you see hyperinflation. Countries like Zimbabwe, Venezuela, and it's spreading now into countries like Lebanon, and just so many countries now suffering massive inflation. And I had to put my headset on, by the way. There was some background noise. First, there was an alarm going off, and then there was a trash truck. I'm not sure if you guys heard that, but these suppress noise a little bit better, so I threw these on for you. Next bit of news I want to get into: U.S. consumer spending surges in January. Now, it's interesting that the business news analysis and the hosts of these business shows were trying to spin this as a good thing. Wow, consumers must have a lot of money. They're spending more because spending is surging. So people feel so rich, they're going out shopping with all this extra money they have. It's actually just the opposite. The savings rate has plunged, as most of you know by now, plunged to financial crisis levels. Debt is increasing at unprecedented amounts every time we look at the new print here. U.S. consumer spending increased by the most in nearly 2 years in January amid a surge in wage gains. Okay, we'll see if wage gains are the real picture here. If it was wage gains, then people wouldn't be getting further in debt, wouldn't you guess? Wouldn't you think that would be correct? While inflation accelerated, adding to financial market pressures. All right, and this is out of Reuters. All right, but everybody here, I think we knew that this was going to happen, but yet the markets are surprised. This came out of left field. This was a shock, and now we're seeing stocks sell off because of this. Companies are starting to slash their dividend payouts. So be very, very careful if you decide to stay in the stock market right now. Even if you are getting a dividend, one, is that dividend safe? And two, is the dividend that you're going to get paid out going to make up for the loss in the value of the stock if the market takes a big drop? Also, we're on the verge of World War III, according to many people. Do you want to be sitting there holding stocks at this time when war could be on our doorstep here in the U.S.? I mean, a lot of people already say we're in a proxy war because we're arming, countries that are in battle right now, engaged in battle. So we're basically involved in this already. We're an accessory to war. So many people would already argue that we are in war right now, even though you may not peek out your window and see soldiers outside. Many argue that we are in a war right now here in the U.S. And it's a war on many fronts, right? There's a financial war going on. There's people that want to totally dominate and have everything for themselves. There's a group of people that want to basically rule the world. Just like the 80s song, Everybody Wants to Rule the World. Was it Tears for Fears? You have people out there that want to rule the world. It's not just a silly song. Well, it's a good song, actually, but it's not just a concept or just something that somebody just made up, like a tooth fairy or something like that. It's something that's actually real. Now, one of the things that we really need to help bring prices down, bring the cost of living down, is more manufacturing jobs here in the US. So if all these jobs added, figures that have come out, like the one from January was 500,000, and the stock market rallied because of it, and the business news channels were talking about it, how great everything is because look at all the jobs added. If these jobs added were actually manufacturing jobs, actually creating something, then you wouldn't see this inflation because you would have enough manufacturing, enough production to make up for the demand, and therefore you wouldn't have the rising prices like we're seeing. You wouldn't have this sticky inflation. I hate to use that term, but sticky inflation. But no, what it is mostly service sector jobs. These are people working in the fast food places, the servers, the uh, hotel clerks, the people punching the computer keys, the people running the cash registers, mostly service sector, not creating enough goods and items to help keep the cost down. All right, people. So as of this recording, we've got the 10-year bond yield spiking up close to 4%. If we continue to see that bond yield rise, we know that the powers that be are letting the markets drop because it's all about the debt markets. It's all about low interest rates, easy money to buy stocks, and then go ahead and the insiders can trade and get out of the stocks themselves. You guys know the game. We're going to wrap this one up. Thanks everybody for being here. Big love. What do you think about today's news? Are you going to be putting your money in a 401k with 5%? Is that enough to entice you to tie your money up for about a year in a CD? Or is it too little and you're still holding cash on the sidelines? Please let me know. Everybody, keep stacking by for now. Big love and peace.